Hi everybody, it's Saturday, September 6, 2025. Our episode starts with our headline, 10-year Treasury yield confirms breakdown after shocking jobs report. Not only did the employment report surprise to the downside, adding only 22,000 jobs for the month of August, comparatively to the expected 75,000, and the unemployment rate being higher at 4.3% than we've ever seen since 2021. The non-farm payrolls report for the month of June was actually revised to be negative, so we actually lost jobs in June. Now, if you remember, the last few reports were revised down massively before Trump fired the head of the person in charge of this data, so all of this data in a nutshell does need to be taken with a grain of salt. After all, lower jobs allow rates to drop both on the long end of the curve and sort of force the Fed to cut, which is exactly what, Trump wants so that he can spend more money. That's the end goal here. So whether you believe the data or not, the market does believe the data, as the 10-year Treasury note yield dropped 9 basis points on Friday, very notably cracking below many psychological levels, suggesting that we are actually likely, in my opinion, headed lower in the 10-year Treasury note yield. One way or another, it was easy to see this coming if you look at a chart of a rate of change. So this shows when we added jobs or lost jobs and how many of them. And you can see since 2021, this has been dropping, looking like it may have been recovering at the end of 2024 a little bit before dropping even lower, and now even lower. Typical business cycle stuff. This is highly expected and normal when rates are restrictive. This leads us into our second headline of the day. Will 2025 be a repeat of the 1940s in inflation and employment? Many of you watching this are probably familiar with Lynn Alden's work, and she was the first one to suggest, hey, this is starting to look like the 1940s. We have super high deficits, and that's the driver of inflation, not a baby boom like the 1970s. And it's true, in a high fiscal deficit situation like the 40s, you can have things act a little differently than normal, and I just wanted to bring that up. Typically, pretty much all of these gray bars, which represent the recessionary periods dating back to 1940, all of them have, as soon as you start going down in the total non-farm payrolls, that's during the recession, like clockwork, pretty much every single time, except for sort of the 40s. So the 1940s, interestingly, it was all the way back in April of 1943 where we saw the total non-farm rolls tick down a little bit, tick up, and then tick down further without getting into a recession for another 2 years. This involved a little bit of extra control on longer term rates, I believe, in this time. But the bigger point here is that the fiscal deficit situation kept things sort of roaring a little bit all the way until the beginning of 1945. So Robschild, why do you have so many Treasury bonds? If inflation is indeed to stay high and this could go on for a few years, isn't that not a very smart move? Maybe, except the demographic, the big key thing that's different about 1940s and now is the demographics situation. Besides the fact that the United States has been kicking out a lot of immigrants lately, I think I recently heard over 1 million, birth rates are very low. And low birth rates are extremely strong deflationary force. Just to compare, a quick AI Google search here, the birth rate in 2025 is significantly lower than it was in 1940. In 1940, the birth rate was at 19.4 live births per 1,000 people, and for 2025, it's around 12. And also, currently, it is below the replacement rate, suggesting that the sale of in an aging population, the older generations have more assets. When there are less people that are younger and not more people, The older people need to compete to sell their assets for the things they want, goods and services. That's very, very, very deflationary, which is a big piece of why I have so much of my portfolio exposed to long treasury bonds. Friday was a crazy day in markets. We have a lot of charts to look at before we get there. Community topics. What moves did you make on Friday, if any? Robschild, if you caught my post on YouTube, I did sell out of my Bitcoin short. Primary reason was this inverse head and shoulders, which we broke very clearly to the upside. This was during the beginning of the day, like right after the weak jobs report came out, and I was thinking, oh my gosh, the Fed funds are dropping and we're back into risk on mode, so I don't want to be holding a Bitcoin short over the weekend, so I got out of it. It did reverse back to the downside, so I don't know what'll happen on Monday. I will likely get back into shorting Bitcoin, especially if we get back up to the $117,000 range. And especially if we get back up to the $123,000 range. Coming up next week, there's some inflation data, but main thing for me is still tariff updates and probably the stock market in general. I think it is possible we are at a longer term top in the stock indices, especially with this employment data, considering the 10-year minus 3-month is basically flat. The Fed is still like strangling the economy, sort of, and it takes a while for that to even have its full effect. And like I said just earlier, on the flip side, when you lower rates in a high fiscal deficit situation, it can spur on the inflation and the growth a little longer. But this employment report could be the thing that cracks markets to the downside, and that could get the ball rolling in terms of asset prices dropping along with people losing their jobs all at the same time. And then we have to go back into that mode of, we gotta, aggressively try to save things. And I'm not sure how aggressive things can get, considering that we are still not at our inflation targets. So it's going to be a wild ride moving forward from this point, in my strong estimation. Thank you for watching, liking, subscribing, commenting, and supporting. See my website in the description to read through my daily reminders, current macro views, and my portfolio explained. All right, let's move on to the chart, starting with SPX, the S&P 500. We dropped only 0.32% on Friday. It was around 10 a.m. where things really fell apart. I was thinking from 9:30 until 10 that it was a simple story of the rates are down and we're back into risk on mode. Who knows how high this thing can go? But then the market really flushed, and traders that are better than me and have access to better information than me are suggesting that institutional money is actually dumping their exposure to stocks right now, which means to me I'm not the only one sniffing out some weakness coming up. Next, I want to go back to TNX, the 10-year Treasury note yield. When you take the bottom of September of 2024, connect it to April bottom of 2025, we snapped right through that. We didn't even bounce that much at that level. And so I am thinking that rates are indeed headed quite a bit lower. This dotted purple line here represents a larger very long-term head and shoulders top starting in August of 2022. We have our shoulder, the bottom here, April of 2023, the top of October 2023. When you connect these two as the neckline, you get a level of around 385. So that could be the next level of support in the 10-year Treasury note yield. I will be reducing, at the very least, my long bond exposure when we get down to 3.6%, as explained in previous videos and on my website. It's the equivalent of the stock market being a PE ratio of 28, which right now it's about 29. I expect rates to actually drop much lower than that if this purple head and shoulders plays out to the downside fully. The pattern is suggesting that we're getting down to a 10-year Treasury note yield of 2.42. Next, TLT, my favorite place to be. I previously had this blue line representing the neckline of an inverse head and shoulders, but I realized that pattern is not super valid anymore. But I just noticed something today, very interestingly. This is a cup and handle pattern right here. Very clearly, actually. You have high volume on the side of the cup. You go down, and then to the other side at the other peak, you also have high volume. And then you have the handle. And then Friday, we very clearly broke and confirmed way the heck above that. So very bearish looking pattern to me. Did I say bearish? Bullish looking pattern to me. Also notably cracking above this yellow line connecting the peak of September 2024 to April of 2025. Currently above that. If we confirm above that, that will give further strength. I don't see anything slowing this down to the upside right now. In fact, if we get market sell-off, if we start getting a risk-off kind of a thing combined with the much weaker jobs data, we're not looking at problems with inflation picking up coming forward. Quite the opposite, and that's what is going to continue to push rates down. Great time, in my opinion, to be exposed to long-duration Treasury bonds. I'm very happy to be in the positions I have personally with that. So with greater chances of more cuts coming in, the 2-year Treasury note yield also dropped a good amount. 8 basis points. I also want to bring up the Fed funds futures. We not only are now pricing in 3 cuts going into the end of 2025, previously 2, there's actually a 7.7% chance the market's pricing in now of one of these meetings to be a double cut. So in other words, 4 cuts by the end of 2025. That chance will increase, especially if, for example, Mr. Market decides to start really flushing here. And another piece of this, again, remember it's September and we typically see weakness in September. So this could be sort of the spark that lights the fire of the recession. But like I showed in that 1940s chart, in the 1940s, we did see a downtick in the non-farm payrolls and we didn't have a recession for a few years after. Additionally, the markets aren't falling apart yet. None of them are. Not only is the S&P 500 and the NASDAQ basically at all-time highs currently, which won't necessarily last, but we also have credit markets, HYG divided by Chi. We have junk bonds super tight. We have the VIX very low, only at 15.19. It's not even near 20. It's not sniffing out any worries at all. I'm sure a little bit of this is the fact that when rates drop, it sort of automatically gives lever to sort of push up the value of risk assets and junk bonds themselves because the cost of lending is cheaper. And also your guaranteed returns that you can get on these securities, the 10-year, the 2-year, when those returns start looking like they're lower, all of a sudden you have to compare that to, well, what can I potentially make in stocks? And so it levers them up sort of on an automatic basis. So one other way to look at this is, with rates dropping as much as they did on Friday, it's almost surprising we didn't see the S&P 500 close at a much higher high. Instead, we had aggressive selling throughout the day. So I am thinking this is actually going to continue to the downside, even though it hasn't started yet. Another interesting piece of the puzzle that I keep bringing up is the dollar is still going flat here, sitting right on top of this line 97.73, which I've had on here forever. It's holding up for now, but I've been talking about this a lot lately, and it is continuing. The US 10-year minus the German 10-year falling, obviously because the 10-year note yield is dropping itself, but typically the dollar follows this, and this falling off of a cliff with the German bonds yields staying sturdy here, it makes the dollar less attractive because of the relative amount that you can earn on the dollars versus euros. Another way this could resolve is if the German government bond yield starts dropping as well, or even at a faster rate, for example, that could support the dollar. But as it stands, there is significant pressure for the dollar to drop, and it hasn't yet. Next up, it's very worth talking about crude oil continuing to the downside, finding support where, we were at back in the beginning, halfway through August 19th or so, closing at $61.96 a barrel. People losing jobs means less demand for oil, and my understanding is that there's less and less desire right now to produce less oil, which is why oil is so incredibly cheap. The reason I say incredibly cheap is the gold to oil ratio, something I talk about. I haven't shown the chart in a while, but this chart goes back to the 1940s and 50s. I want to remind everybody that in this period before 1970, gold was suppressed. It was tied to the dollar. Once we got off the gold standard, obviously gold was allowed to rise, especially to other things like crude oil. But I also want to note in 1976, we got to a lower reading of this. In fact, many times in history, we have seen 1 ounce of gold buy you only as much as 7 barrels of crude oil. And right now, we have never seen gold more expensive to crude oil. So either crude oil is way too cheap or gold is in a bubble, or maybe it's a little bit of both. I am on the side that I think gold is in a bubble, and the bubble is getting bigger. On Friday, we had a new all-time high in the price of gold, getting to almost $3,600 an ounce. Very clearly now breaking to the upside out of this consolidation. So this is now interpreted by the market as a very clear bull flag that's headed to the upside. How high can it go? Who the heck knows? I think bubbles are dangerous, and I'm not going to participate in this, and it's fascinating to watch. Next up, I wanted to bring up copper. It seemed like it was getting a bit bullish earlier in the week on Tuesday, and we gave up all of that and more to the downside. We're still in this sort of channel here, looking like we want to break down to the downside, in my estimation, on Friday, reaching to the lower end of the channel there. I am very curious how far this can go. I am not of the opinion that this can go on forever. For gold, if gold drops significantly while gold is still rising, this is historic here. The copper to gold ratio, has it ever been this low? At 0.000091 ever? I don't think it has. I don't think copper has ever been in the history of the world this cheap compared to gold. How is this going to resolve? One is going, like they say sometimes in charts, when things diverge from their historical norms, it forms sort of alligator jaws that are just inevitably going to chomp back down. So is copper going to rise to gold, or is gold going to fall to copper? I am very certain one of these things will happen, if not both of them at the same time. But imagine a scenario where copper drops and then gold has to chase it to the downside, which is actually another possibility, especially considering how expensive gold is compared to, say, crude oil, and also housing, and M2 money supply. I want to also just throw in here the way that I look at gold in general. My idea is that central banks don't actually control the price of gold. They can do so until they stop buying gold. When they're buying it, essentially they are in the process of sort of devaluing their own currency. But when push comes to shove, you remember it's the value of goods and services that people provide that has to be priced somehow. Eventually, it's not the central governments that control that anymore. It's the people that decide what they're willing to accept. Think of it like this. If you had a town on an alien planet, all right, And you had these houses that were just collecting all of the gold, collecting all of the gold. They have all the gold there, and they say, oh, we have all of this gold, all this money. But the people that are making things, that are working, that are doing things, you know, this entity now has all this gold, and let's say they want to sell some of the gold to get some of those goods and services. Who gets to decide what how much goods and services you should get for that gold? Is it the people handing out the gold, or is it the people giving out the goods and services? I am going to argue till I'm blue in the face that this is it's can be temporarily controlled by central bank buying, but over the long run, it's not the central bank that can decide how much gold is worth. Also consider that gold, like anything else, can have its booms and its busts. It can have periods of extreme high popularity and extreme nobody ever wants to touch this again. No different than any other asset class. People will make money on the ride up as gold goes up, but that kind of risk is not for me. Next up, I wanted to bring up Nvidia stock. Continuing to the downside on Friday, lost almost 2.7%. This company is an enormous part of the triple Qs and the S&P 500. And just like I think it was Cisco that sort of popped the dot-com bubble, this could be the popping. I am very surprised to see SMH, a semiconductor index, going up on the same day by 1.18%. So Nvidia has not had the power to drag this down into the dirt, not quite yet. Next up, I wanted to bring up the 10-year break-even inflation rate. On Friday, it continued to drop, and it's dropping at a pretty rapid pace here. This makes sense with weak jobs data. Obviously, we are not going to be expecting inflation to be going higher and higher if everybody is losing their jobs. Quite the opposite. Last chart of the day, it's one of the stocks that I have on my website. It's one of the stocks I'm invested in. Ingalls Market. My plan is to sell this between $80 and $90, which equals a 14 to 15 10-year average PE, which is still, that's very low. Also, it's equal assets to liabilities without any goodwill. We very recently, over the past few days, very clearly and strongly broke above this little yellow trend line here, dating back to January it dates back further. December of 22, connecting exactly to January 8th of 2024, or the 2nd, I think, connecting exactly the same exact line to July of 2024, hitting it again in November 2024, no, that's the blue line, sorry. More recently, we hit it and we broke through it. So I am very, very bullish. This is a very extremely bullish looking chart in a Gramscian type of a stock. I'm very excited about this getting up to my sell zone so I can sell it and find something else to do with that money. And that's all for me in my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.